Next stop is the East Side Motel.
Again, welcome, and we're going to do a series of quite important videos regarding some very deep principles and foundations that we need to make sure that are habit. Because if these things aren't understood, then basically they will put a blockage in front of your journey towards success, towards our goals here. So, I'm going to keep this so simple. When we look for a trade, there's going to be an entry point and there's going to be an exit point. Now, the exit point can either be in profit or it can be in a loss. Okay, so what I'm going to do is I'm going to keep it simple first, and we've got two tools at the bottom here. You'll see the long position and the short position. And what I'm going to do is we'll just put the long position here for now. Okay, and as you can see, it's two boxes. Now the green box is the reward. Okay, long means going upwards. So if this moves into this, if the price moves into this green box, then you'll be in profit. And the opposite for if you're in a loss. So it's very simple. So let's say we're going to use this tool, okay, to take a position, for example, where it is now. Okay, we can just put that there. And we can, let me just adjust it actually, it's not so clear. To be clearer now. Okay, we can use this tool to start to measure things and to start to potentially look at some of the details. Now, you can adjust this and like this compact stats mode, you can turn this off and you can see some more details there. So we can start to measure this thing. So we could say, okay, we want to go long here, and we're saying that, having the stop loss here, we will be risking, if we look here, 17.9 points, okay, or 179 pips. Okay, so this is what I use to measure the risk. Now, once we've understood this measure risk, so just looking at this trade, if I was going to take this trade, for example, the stop loss would be below this weekly low here, this line, okay, so the stop loss would be there. So we can say that to there is 29 points, and then you can use certain calculations like however much your broker charges per point, per pip, lot sizes, and so on. So we have a base now to make some calculations. So alternative to this, we can extend this to our potential target, and then we can see here risk-reward ratio, what the risk-reward ratio is. Okay, so the risk-reward ratio is simply, if I change this to 2 to 1. So here is 2 to 1. So we are going to get 2 back to our risk. So if I was just to draw a box here to measure that, and then we can see that this is 2 times that. Okay, it's very simple, very simple. But there's some mathematical principles here that need to be understood regards to probabilities, statistics, math. And it's important that we understand this, because in the next video that I'm going to play here, you'll understand why 1.5R is important.
One of the rules they followed was risking only 2% of the account size on a single trade, which doesn't sound any different than the risk management rule most traders use today. However, if there was a 10% profit in the account, they were told to reinvest the profit and risk 2% of the new total account size. Furthermore, if there was a 10% loss, they were told to risk 2% of the new smaller size. See, in my compounding method, I am reinvesting the profit when I am up 30%. Furthermore, I'm adjusting my position size so that the risk per trade is 1 to 2% of the new and bigger account size. If I lose 30%, I'm not changing anything. But in Richard Dennis's compounding method, he is not only reinvesting and adjusting the position size when he is in profit, but he is also reducing the position size when the account size gets smaller. Which method of compounding is right? Which one makes more money? And does reducing the position size when there is a loss even make sense? To find out, I ran 5 experiments, took 600 trades, and simulated 9,000 trades. The data you're about to see is not only surprising, but you will most likely end up using the best compounding method we have found. In the first experiment, we will test if reducing the position size when there is a loss is a good move or not. Here I have the probability section of the official Trading Rush app. On one side, we will simulate 1,000 trades with no adjustment to position size when there is a loss. For example, we will risk 1% per trade, and if there's a loss, we will still risk 1% of the initial capital. On the other side, we will simulate 1,000 trades, but this time we will reduce the position size when there is a loss. For example, if the account gets smaller, we will risk 1% of the current capital and not 1% of the initial capital. To make sure there will be more losing trades in the experiment, I used a 30% win rate and a 1.5 to 1 reward-risk ratio. As soon as I started the simulation, the account balances of these two accounts started to fall like it was a market crash. By the 400th trade, the first account that didn't use any adjustment methods and risked the same amount every trade blew up the account. On the other hand, the second account where the position size was reduced when there was a loss didn't blow up the account even after 1,000 trades. Furthermore, at the 400th trade, the second account still had 40% of the initial capital left. The first experiment shows us that reducing the position size when there is a loss and when the account gets smaller is actually a good thing. But what if your win rate is good? Let's say your win rate is good, like 55%, and you are pretty confident in what you are doing. Then what? Will reducing the position size when there is a loss even make sense, since we are not going to lose money in the long run? To find out, I simulated 1,000 trades with a 55% approximate win rate on 2 separate accounts. The first account will compound when there is a profit, but will not reduce the position size when there is a loss. On the other hand, the second account will compound when there is a profit, but will also reduce the position size when there is a loss. As soon as I started the simulation, the account balances of these two accounts started to move in the upward direction. And after 1,000 trades, the first account was up by approximately 3,000%. What's interesting is that the second account was also up by approximately 3,000%. The second account, however, was slightly better than the first one. What that means is reducing the position size when there is a loss won't make a big difference in the long run if the win rate is good. But since it significantly reduces the probability of making a big loss and blowing up the account in the short term, it is a better idea to reduce the position size when there is a loss and the account size gets smaller, just like the multimillionaire Richard Dennis recommended to turtle traders. In the second again, on the exact same market structure 3 times. The first time, I didn't use any compounding method. The second time, I compounded when there was a 10% profit and reduced the position size when there was a 10% loss. The third time, I compounded every time there was a profit and reduced the position size every time there was a loss. In this experiment, the account with no compounding or adjustment made 55% profit. The account that compounded and adjusted the position size at 10% change made 68% profit. And the account that compounded and adjusted the position size after every trade made 71% profit. In other words, with the highest win rate trading strategy, compounding and adjusting the position size after every trade was the best compounding method. Since the win rate is so low, all 3 adjustment methods in the third experiment should make a loss. But if our previous data is correct and compounding and adjusting position size after every trade is actually the best method, then the same method should also make the lowest amount of loss with a bad strategy. And in the third experiment, it did. The account with no adjustment method made the highest amount of loss. The account that compounded and adjusted the position size at 10% change had a slightly lower loss. And the account that compounded and adjusted the position size after every trade had the lowest amount of loss. After looking at all of this data, we can safely say that we have found the best compounding and adjustment method. In the fourth experiment, I simulated 1,000 trades with no compounding on one side, and 1,000 trades with compounding and adjustment after every trade on the other side. In the end, the account with no compounding was only up by 260%, whereas the account with compounding plus adjustment after every trade was up by 1,300%. But what if your win rate is even worse? Let's say you are an absolute beginner and are getting a win rate just above break-even. With a 1.5 to 1 reward-risk ratio, the break-even win rate is 40%. So, in the fifth experiment, let's see if compounding and adjusting after every trade will even work when the win rate is just above break-even, something like 45%. With no compounding, the first account was only up by 140%, whereas the second account with compounding and adjustment after every trade was up by 350%. There is clearly a big difference. Till now, I have been compounding around 30% profit without making any adjustment to the position size when there is a loss. But after 5 experiments, we have enough data that says compounding and adjusting position size after every trade is not only better, but adjusting position size when there is a loss significantly reduces the probability of blowing up the account.
There's a lot of trade that, I can put analysis on any of these charts and things, but we have to understand that we need to be realistic about some of these entries. So I'll be going over all of the ins and outs with you, okay, in a one-to-one session. So once you understand all these things and apply this risk reward, the risk reward needs to come in front of everything, because this is what's going to dictate your success. And it's going to be a slow process. It's not like buying some Bitcoin and then next year you're a millionaire. It doesn't work like that. This is more slow and steady, and it's safe. Okay. So we're going to take some examples here and just hammer this home. Okay. So as price comes down here, we've made this low here. It's come back up. It's come back down here. Okay. Longs can be taken there. Okay. Where's the stop loss? It's going to be below that wick. Okay, and we're going to shoot for 1.5R, and we can use this risk reward tool to see exactly where that is. Okay, so we see the target here. So as this price has come down here, it's come back up. It's about to go down back towards that, and boom, we've hit our target. So using this wick, this line as the stop loss is a great risk reward. Now look where it's gone. Let's just extend this out. 13, a maximum of 14.8R of one trade. Amazing. Okay, yeah, cool, hindsight trading, whatever. But let's say we do this up here. Okay, we do the same thing. We've got the wick, we've got this high, and I actually traded this. So we could take one of these wicks, for example, and I'm just trying to hit home the 1.5R here. So 1.5R, boom. What did we get overall? Nearly 5R. Okay, so we'll leave that at 1.5R. Next one. You see now here is a good example, because we've come down and we've made this low, and this line will currently be here. Okay, it'll be sat right there. As this comes up, it's going to come back down. And like we did here, long position could be there. Okay, we talk about having a stop loss here. Look what's happened, the wick, boom, took out the stop loss. Following wick, boom, took out the stop loss. Okay, but look at the candles closed back above this level. Yeah, so that one didn't quite work out. But then, I'm simply just showing you here about the 1.5R, not how to manage trades and things, which will come later on. But the idea would be to keep an eye on the 1 hour chart or the 4 hour chart and witnessing these wicks come back up and close above this and then going off. Okay, so here, which we already talked about, so we can pull the stop loss right in, look for 1.5R, and then let any trades run. Okay, here Yeah, so I think you've got the picture now. Okay, so so what's the point to take away from this? The point is to aim for 1.5R at all times. We have to understand where our area is for exit, and also we know very clearly where the point is, where it's like, okay, this trade is just turned into a mess. It's passing validation level. The whole setup, there's no setup here anymore. Okay, that's what that means. So for example, coming back to this one. Okay, so we're back and we've got this set up now. So let's just watch this play out. Okay, so I'm going to just forward this to a point where a potential trade. So here we've got a potential move look. Okay, so you see this, we've had a wick and then we've got some candles within that. Okay, so like I said, we would potentially use this as an entry, looking for 1.5R minimum, and we're here. Now at this point, okay, we've said, okay, this is the risk. This is like the 1R, okay? You say the stop loss is here. So let's see what happens. So as these print, okay, look what's happened here. Okay, I can't quite take the labels off this. There we go. Okay, you look at where the stop loss is. Exactly. This is why I have the stop loss just below the line. I don't have it on the line. It's just below, because sometimes we have that. Now, at this point that I've seen this spike down, and this is just some tips for how to manage the trade, but it does bring home the bigger point I'm trying to elaborate on, is that this candle has spiked down past that previous low but then closed inside. Okay, so now I'm going to be like, right, I'm going to adjust this a bit again, and I've seen is try to try to trick traders. Okay, let's see what the next one does. Oh damn. So look at what, again, what's happened. It's gone down, scooped all them orders up and then come back up. Okay, so having a stop loss there, yeah, you have exited if this was to collapse. Okay, cool. But this is when we're going to get into the strategies and how to manage trades and things like that. It's simply the understanding the 1R, okay, and the evolving R. Sometimes it's like evolving, like I said, it's because when this has come, then we see this. Okay, we're like, right, okay, this is our risk now. Where's 1.5R? It's going to be here now. Okay, so it comes back to the money management. How much are you going to risk? Okay, so this calculation here, if I bought 100 for £1 each and then the price goes up to £2, if I bought again 100, okay, then in total I'm going to have 200 at £1.50. Okay, so it's going to basically take an average of the two, and that's basically just dollar cost averaging. Okay, so we'll explain a little bit more in detail here. So we're going to wrap up in very simple format the dollar cost averaging. Okay, so using the same tool, let's say the price, let's do it on replay because it's going to be a lot clearer. Okay, here's the price, and as price comes down, okay, it's just bounced off the 50% level, so we're going to take an entry here. And our target is obviously up the top there, and our risk below the 100% line. But let's not focus on that for now. So what I want to bring home is the middle line. This is where we're at the moment. So let's just signify that with an arrow. Oh, the arrow's just there. Okay, arrow's already in. So moving forwards, next candle looking good in profit. Next candle, oh okay. and then we are lower. Okay, so at this point, we're going to be like, oh no, our trade has, it's not going our way. Something I just want to take put note of is that let's just call it $100 here. So this is a $100 entry, and this just makes it easier for when I'm explaining it. So if we just, oops, wrong button. So if we just clone this, as prices come down here, we've entered again on the 70.5 level, but actually, being realistic, we probably wouldn't. So on this next candle, oh, right there. Okay, so as that was poking down there, I'm not going to get into the ins and outs of what I did in the trade, but another $100 here. So we've got two of the same size entries, okay, in, and what that's going to do is it's going to average out our position. Okay, so second entry here, same risk, same reward. Okay, so firstly, let's look at the risk reward ratio, 1.33. Okay, this reward ratio, 2.73. It's double. It's over double. So each one of those. So overall, I just want to make this clear. Overall, the reason why we're dollar cost averaging, we're going to be in between. So you see this kind of area here. We're in between that. So because we've got two positions, we'll just measure in between. I mean, you can use the Fibonacci tool with the 50% line, but I can see just with eye. Okay, so overall we'll be in $200. Okay, so that's it in a nutshell, basically. This can be, instead of a numerical kind of currency, it can be a percentage. So instead of $100, you've got 0.5%, and then overall here you've got 1%. Okay, so that's how we're taking the approach to the dollar cost averaging, and once you learn this, we can split the potential trade entry up into 3, maybe 4 different entries. I have some very, very advanced entry strategies, but we want to start on the foundations of why we need to respect this. Okay, so we're just building on the layers of foundations of understanding, and once this is set in stone, you won't want to take a trade without running through this. Okay. Okay, so what we was doing is we was back here, we measured it, it was 17 points to the stop loss here. So if we was to open one lot, then we would be risking £17. Now, our account size, let's just say, is 2k. So we know 1% of 2k is the account size divided by 100 to present 1%, and that's £20. You can do very quickly by moving the decimal place 2 points to the left. 0.5% is half of the above, which is £10. So basically, to calculate the risk, you need to know the amount of what you're going to risk, 0.5% or 1%, so in this case £10 or £20, divided by the amount of points. Okay. Now remember, £1 per lot, £1 per point, 17 points, so we can calculate this easy with regards to the lots. And then what we'll do is we'll know then it's 1.2 lots to come over and enter into the platform when we open the trade. So this is very important to understand, and it might be an idea just testing on the demo account, or even just contacting the broker and asking, what's the price per point here? What am I dealing with? So we know then when the price comes down to this point, we're going to hit £20 loss. Okay. So why am I talking about this? It's very important to understand the amount of risk. So I've done So just a quick example about dollar cost averaging actually while we're covering it. Okay, so so at that point there, okay, so we're in at this point with 1%, let's say. Price has come down to close to the stop loss and then come back to here, okay. So if I zoom right in here, and we can safely say that if we was to enter here, another 1%, okay, we would be halfway in between the entry point and the point that we're entering now, okay? So then the trade would be at this particular position, okay? So what you would have to do is if we rewind, I mean this is a little bit, we're getting a bit too into what we'd actually do on a trade setup here, but I just want this to, for anybody following along with this thought process, can really grasp this, is we would do the same thing what we did here. Okay, so we've got this trade running already, we're about to enter another one here. Stop loss, is it the same or is it different? Okay, now obviously we know from hindsight that the level's here, so we can say, right, we're here. So now we've got 2% in at that point with this stop loss. Okay, now that's how to manage. Now let's say we know that happened. Okay, we know that happened and it come down. Now as this is coming down here, okay, on a 4-hour chart, we can witness on the 1-hour chart or the 15-minute chart what's going on, and we can still have this trade running. In fact, this trade will be running on the lower time frames, not this time frame. So with that being said, to just sum up this example, you see how this wick has come down past this stop loss. The wick has come back up. Okay, we talked about this wick. This was our original entry, and the candle closure above. This spiked all the way down to here. Now on the lower time frames, this is where we can really unload these extra shots, these extra 0.5% in down, and as it's made its low here, it's come back up. Okay, now bear this in mind. As this is coming down here, let's say it's here, okay, you're at -2%. Okay, as this wick comes down to here, you could be at -3%. Okay, so just understand that, you know, I said I'd risk maybe up to 5% on a trade. Okay, just here I might risk up to 5% on a trade. So as this is coming down, I'm actively having an idea about, okay, this is 3% of my account now, what's going on, do I want to close this, or so on. So this is why you need to understand where the invalidation level is and how much you're willing to risk. Okay, so I think we're going to wrap this up now. I think I've made the point clear. Okay then, so to wrap this video up, you know, I just want to cover, you know, what to do next. So obviously we've watched this video, you know, take notes, you know, get this inside of your head because it's important, because you know, anybody coming into the group, you know, needs to be serious. The reason why segregating ourselves, isolating ourselves, is because of reasons that I will share in private with people, but only looking for serious people. Please be serious.
But you can't be any geek off the street. Gotta be handy with the steel, if you know what I mean. Earn your keep.
You know, and be open and honest, you know, because what I don't want to do is I don't want to go down this path and then have to change paths, which I've done a couple of times with groups. I've just noticed something. I don't want to be rude, I don't want to be weird or anything. I just see things and then we'll move. Okay, so what I want to do is bring correct people together. I want good energy. That's very important. You have to have the correct energy. Okay, so moving forward, please learn this video, the money management strategy, and then get in contact with me. Okay, please contact me direct, speak to me, and we will have a discussion, and then we will schedule a one-to-one session. Okay, and then we will get all of the things that need to be put forward out of the way, and then we'll move you into the Discord group, and then you can see the things live. Then once you're in the group, we will schedule maybe one or two other one-to-one sessions, and I will mentor you personally, and then we can all trade together. Okay, sound good? So hope that's okay. And I will say this initially, guys, I'm doing this for free, okay? But what I do expect is some gratitude down the line, some payback, okay? So when we get all the hard work out of the way and the money starts rolling, it's gotta give it back to me. You gotta give me something, okay? Because I did this with 2020. I think it was 2020, or in the start of 2021. I was managing some money, we was managing some people, and I just didn't seem to see anything come back. And this is, it's human nature. That's fine. But I don't want to ask. I would rather be. I'm giving. Okay, I'm giving a lot of time and effort, and that needs to come back. Okay, so with all being said, have a great day, and I will see you soon.